Simple IRA, Income Retirement Account, is made for small businesses of less than 100 employees. It functions very much like a 401k plan. Deductions are exempt from federal income tax withholding. Some of Simple IRA plan features are different, such as contribution limit is lower, and unlike 401k plan, with Simple IRA, employer's contribution is required, and it's called matching. For example, an employee contributes 6% of income to the retirement plan. The employer then must match, but the amount of matching depends on each employer. It could be 100%, it could be half, or any other type of matching. Payroll deduction IRA is the simplest retirement plan. Basically, this is just an account that's opened by the employer for the employee to contribute to it. Deductions are not exempt from federal income tax withholding. Employees get tax benefit when they file income tax return at year end and claim the deduction from their income. Employers are not required to provide retirement plan benefits to employees. However, if they do, they are subject to the Employee Retirement Income Security Act of 1974. It sets forth the requirements for retirement plans, such as how the plan is funded, accumulation of benefits, which are the statements that the employees would receive similar to a bank statement, and other types of requirements. In a nutshell, the employers must administer the plan accordingly and appropriately. Cafeteria plans. That's a group of benefits offered by an employer. These include health insurance, health savings account, flexible spending account, group term life insurance, even adoption assistance. A cafeteria plan must have at least one taxable and one non-taxable option. Important to note is that the cafeteria plans are exempt from federal income tax withholding and from FICA taxes. Charity, union dues, and insurance are voluntary deductions. Earnings are withheld from employees' paycheck and remitted to the respective organizations, the selected charity, the union, the health insurance company. The payroll register contains information that you see on your paycheck, gross and net pay, and all the information in between, all the deductions that we have talked about, either mandatory or voluntary deductions. Accounting for payroll. An employer must record a journal entry for each element in the payroll register, and each payroll deduction is owed to a corresponding entity, institution. For example, federal income tax withheld is immediately owed to the U.S. government. Charitable contributions withheld are immediately owed to the intended charity. Information from payroll must be summarized and recorded in the accounting information system. A journal entry is used to record the payroll expense and the payroll liabilities to the general ledger. Expenses like wages and salaries are debited, and the withholdings are credited. These withholdings, such as income tax, Social Security and Medicare taxes, union dues, 401k contributions, are recorded as payables or liabilities. Because employers are liable for these withholdings, they have the obligations to collect them and remit them to the respective organizations or institutions. So here we see in the journal entry example, wages expense and salaries expense are debited, and then federal income tax payable, state income tax payable, Social Security tax payable, Medicare tax payable, and so forth are credited to show the obligation, the liability, the increase in these liabilities, and cash is credited, showing the decrease of cash from the payment, $5,582.40.